Japan has the world's largest national debt. Data from the International Monetary Fund, IMF, shows that Japan's gross public debt, as a percentage of its gross domestic product, GDP, is over 261%. That makes it higher than the United States, which has 121%, many of Europe's highly indebted countries, and any other country that has been plunged into a debt crisis. Having this high of a debt for a country makes everyone wonder, why hasn't Japan collapsed yet? Shouldn't its economy be in a freefall as its government and people can't pay its debt anymore? Well, there's a reason why Japan is still an economic powerhouse, and to understand why it hasn't crumbled on its knees, we must first see how Japan's national debt rose to this much. There's a lot of reasons that pushed Japan's national debt to increase to where it is today. There is no single reason for it. It's a mix of demographic challenges, economic stagnation, large-scale government spending, deflation, and fiscal policies. The debt increased, however, back in the 1990s. In the 1980s, Japan's national debt as a percentage of its GDP was just 47%, and 2 decades later, by 2000, this rose to over 135%. Most people already know what happened in the 1990s, but in case you're not aware of it, Japan had a massive asset bubble driven by speculative investment in real estate and stocks. When the bubble burst in 1991, Japan entered what is now referred to as the lost decade, a period of economic stagnation, deflation, and slow growth that lasted well into the 2000s. As the economy slowed, tax revenues declined, and the government responded by increasing public spending in an attempt to stimulate growth. This included large fiscal stimulus packages that focused on infrastructure spending. These packages temporarily boosted growth, but also significantly increased government debt. By the mid-1990s, Japan's debt-to-GDP ratio had risen to 70%. This fiscal stimulus package was the problem. Fiscal stimulus are designed to stimulate economic activity by increasing government spending or decreasing taxes, aiming to boost demand and consumption when the economy is struggling. Fiscal stimulus packages are a tool used by governments to avoid or alleviate economic recessions. The Japanese government did not just rely on fiscal stimulus temporarily, but they continued it throughout the 1990s and 2000s. They wanted to prevent the Japanese economy from slipping deeper into recession. While many economists at that time were confident that this would work, and it would ensure Japan's economy would continue rising, it wasn't enough to restore everything. Japan's GDP growth remained weak, averaging less than 1% per year, and the country slipped into a cycle of relying on public debt to sustain the economy. During this period, Japan also began running significant primary deficits, meaning the government's revenues were insufficient to cover its expenditures even before accounting for interest payments on the debt. The persistent budget deficits necessitated more borrowing to cover both the deficit and the growing interest payments on existing debt. The high level of government spending, combined with low economic growth and declining tax revenues, exacerbated the debt situation. To put it simply, Japan was spending more than it was earning, which led to a cycle of debt accumulation. To top off these issues, another major problem was deflation. Beginning in the 1990s, Japan experienced persistent deflation, a decline in the general price level of goods and services. Deflation worsens debt dynamics because as prices fall, the real value of debt increases, making it more difficult for the government to repay its obligations. In a deflationary environment, consumers and businesses delay spending, expecting prices to fall further, which weakens economic growth and tax revenues, further aggravating the fiscal deficit. Now, the central bank has also pushed efforts to stimulate inflation. What they did, however, was through various unconventional monetary policies, such as quantitative easing and negative interest rates. Quantitative easing is another concept that simply means the central bank purchases government bonds and other financial assets from the market in order to inject money into the economy. The goal of quantitative easing, QE, is to increase the money supply, lower interest rates, and encourage borrowing and investment. By buying these assets, the central bank raises their prices, which lowers the yield or return on those assets. This, in turn, reduces borrowing costs for businesses and consumers, making it cheaper for them to take out loans or invest, theoretically stimulating economic growth. Despite all these, inflation still remained stubbornly low. This has made it challenging for the government to improve its debt dynamics, as deflation leads to higher real interest rates, increasing the burden of debt servicing. Then, we also have Japan's demographic trends, which also played a significant role in the rise of its public debt. Japan has one of the fastest aging populations in the world, with a shrinking workforce and an increasing proportion of elderly citizens. The old age dependency ratio, the number of people aged 65 and over compared to the working age population, has been steadily rising and is expected to peak in the 2050s. An aging population increases government spending on social security programs, particularly pensions and healthcare. As the elderly population grows, so do the costs associated with providing for their care. Public spending on health and long-term care is expected to rise by up to 2.8% of GDP by 2030, driven largely by demographic changes. Now, the Japanese government has implemented various strategies to reduce the country's debt. They wanted to fix these fiscal imbalances through tax increases, particularly by raising the consumption tax. The consumption tax was introduced in 1989 at a rate of 3% and was subsequently raised to 5% in 1997. More recently, the government implemented 2 more rounds of consumption tax hikes, first to 8% 2014 and then to 10% in 2019. The consumption tax increases were intended to reduce Japan's primary deficit and stabilize its debt. However, the tax hikes have been politically unpopular and have faced resistance due to concerns that they could stifle economic growth and exacerbate deflationary pressures. Politics have been an issue with the Japanese government, as some or actually many policies have been difficult to push through due to severe opposition. One famous person that had tried to change all of these was former Prime Minister Shinzo Abe. Abe and his administration launched Abenomics in 2013. This was a comprehensive economic policy package that included aggressive monetary easing, flexible fiscal policy, and structural reforms aimed at boosting growth. But this was not enough. Growth remained weak, and the structural reforms necessary to improve productivity and labour force participation have been slow to take effect. Now that we have a clear understanding of how Japan's debt rose to these levels, it is then important for us to understand why Japan has not collapsed yet. Many countries globally have faced a recession, even some a depression due to high debt levels. But why not Japan? Well, one of the key characteristics behind this is the domestic ownership of debt. Over 90% of Japan's government debt is held by domestic investors, including banks, pension funds, and insurance companies. This has insulated Japan from the kind of fiscal crises seen in countries like Greece, where much of the debt is held by foreign investors. The second characteristic is due to low interest rates. Japan's ability to issue debt at extremely low interest rates has been a key factor in preventing a fiscal crisis. The Bank of Japan's monetary policies, including QE and negative interest rates, have kept borrowing costs near zero. As a result, the government has been able to continue borrowing to finance its deficits without facing a sharp rise in interest payments. But anyway, do let us know what you think. Thanks for watching.